Hey guys, it's another educational episode. It's Dave Hathaway. I'm bringing to you Josh Shein from Trius Lending Partners to speak to you about hard money lending, how it can help you be a successful investor and build or grow your real estate portfolio. I've had the pleasure of doing business with Josh in our portfolio in the past. I've also invested with Trius Lending, but I want to hand the mic back to Josh, who's been in the mortgage industry for 23 years, and just let him introduce yourself, let you know why he's relevant to speak about hard money lending today.
Sounds good. Thanks, David. Great to see you. Thanks for having me on. I love the content you produce here and the education and information you share with new investors and people new and somewhat new, I guess, to the industry. Super helpful, great information, great opportunity to learn from someone like you who's had tremendous experience and tremendous success. So kudos to you for that. Great to be here. Just really briefly about me. I've been in the mortgage industry, as you mentioned, for 23 years. A few years before that, I was in a medical products industry, but most of my career has been in mortgage financing, real estate financing. Most of that time was in the owner-occupied space, right? People buying their home, refinancing their home. And that's a licensed space, right? We have federal licensing, state licensing, et cetera. I had my own company for many, many, many years, and then went under a much larger national platform. And so I was overseeing national offices on both wholesale, retail, and operations, and traveling around the country. And I sort of wanted to come back home, spend some more time at home, see my family a little bit more, and work really on a more local level. That's really what it came down to. And that's where the hard money space, the investor and commercial space on a local level was just a perfect fit for me. I partnered up with Steve Bond, who had started this company back in 2003. And we had known each other. We get along well, along with his son, David. And the three of us are the owners of the company. And I love this business. I love this industry. We're able to establish and build strong long-term relationships with people, especially people starting from scratch, really holding their hand, like the kind of things you're doing here, David, is helping to educate, teach, inform. That's what it's all about. There's a lot of fear, a lot of anxiety associated with getting into buying your first property, flipping your first property, owning your first property. And we want to sort of break down all those walls and barriers and say, hey, let's have a conversation. Let's talk. We don't bite, right? It doesn't have to be as scary as you may think. Let's just sort of take it one step at a time and let's make sure this makes sense for you and for us on the lending side. And so what we do is provide the funds for people to buy that first property, whether they're going to hold it, whether they're going to flip it, whatever they may be doing. And we really go out of our way to make sure that it's an educational experience and that the hand holding is slow, intentional, and very patient. We're not just here to close a loan with you. We're here to build a long-term relationship. And that's really what Trius Lending is all about.
Gotcha. Thank you for the introduction, Josh. To even put it further for viewers, what is hard money? What does that entail?
A hard money lender is a lender that provides funds against a property, against a non-owner occupied property, not a property you're going to live in.
Mm-hmm.
Gives you a mortgage on that property for buying it and or rehabbing it. That's what we exist for. That's what a hard money lender does. A hard money lender does it quicker and easier, but it is essentially a mortgage against a property.
What problem does hard money solve?
Hard money solves the problem of speed and ease to access capital. Hard money is not a replacement for someone with bad credit or no income or no asset. That's a misconception about hard money. Hard money exists to provide easy and quick capital to real estate investors to grow their businesses, to scale their businesses. It's extremely difficult to bootstrap growing a real estate portfolio, period. You need to access funds to do that.
And I know that's huge. Hard money lending is also there for the purposes of properties that your conventional loan, your banks won't lend on for like big value add properties. Am I wrong?
Correct. So the traditional bank, the traditional mortgage product that's out there. From my years in the mortgage industry, you know, I've seen more appraisals than I can count. And the traditional lender would look and say, this property isn't livable. It's not habitable. It doesn't have running water. It doesn't have electricity that works. Well, that's a great opportunity for a real estate investor, not such a great opportunity for a traditional mortgage lender or a bank. So they will shy away from those. They will straight up say, we don't want to touch that kind of a property. It's just too risky for us. And so the opportunity is to come to someone like us who understands what can be transformed from a shell, from a ground up type of opportunity where it's sort of gutted down to the studs. We understand how that can work. We understand how that value can significantly increase once that work is done. And so we're lending very often on both the purchase you're paying now, but when we're looking at the rehab funds that we're going to give you, The rehab funds and how much rehab money we're willing to give you is based on what that after repair value is going to be. So you're buying this for X, but we're hoping it's going to be worth 2X down the road by you putting money into it and improving that property or turning it from a non-habitable, livable property
Yeah.
into a nicely livable and habitable property.
Yeah, thank you. Well said. I want newer investors to know, hey, this is what hard money is for. This is why sometimes you have to use it and why you can't go to your Wells Fargo, your Bank of America for a traditional loan because, as you said, with a property being inhabitable, and these are more your value add properties, the properties that you're going to put a bunch of rehab into. Your traditional institutions, sometimes they have products that solve for this, right? And you correct me if I'm wrong because you are the specialist, but sometimes they have products that can make this work. I think it's a rehab loan, but there's tons of paperwork involved. And then you also have to qualify on the income side. So you also have to have, a job for 2 years. If you don't have W-2 income for 2 years, that's another problem of the traditional institutions that your hard money you don't have to worry about as much because they're looking more at the asset than they are at the person. Like you said, you can't have horrible credit. I mean, you're still have to have some skin in the game and you have to have reasonableness with cash flow and how you handle money. That's why it solves those problems. And the speed when you're talking about, let's say, maybe an auction. I know that we've been to several auctions and sometimes the auctioneers are flexible and they give you a 30-day time frame to close on the property, but some of them only say close in 72 hours or close in 10 days. And in those cases you can't use even the rehab loans from the banks or any of the traditional stuff. So it solves that as well, which I mean you stated with speed, but I'm just giving people kind of a little bit more context so they can understand.
100%. When you're looking at those different options, very often you simply don't have a choice, which not everyone has hundreds of thousands of dollars to just buy a property and rehab it. And I would argue that it's not a great use of your resources, depending on what percent of your assets that is. I've had people who said, I'm taking every penny to my name and putting it into this property. I say, that's not a great idea. I would recommend you use some leverage, borrowing some of that money. I think is a better and safer thing. You always want some safety cushion. You always want some money in the bank for an emergency rainy day fund. I just believe that's sort of a principle of like financial management, right? So I don't want you to clear out your bank accounts in order to get into real estate investing. This allows you to put a lower amount of money down, but have access to larger amounts of money. That's what leverage is all about. And being able to do it quicker, some of the auctions will require a hard money lender approval or cash approval. They will not allow, and even some properties as the market has gotten hotter and inventory has slowed out there, there are sellers who will say, I will not accept a traditional loan, a traditional bank or mortgage company loan because I don't want to wait that long. Too risky, too uncertain, too unpredictable, just too much time. I can't afford 30, 45 plus days and maybe it turns into 60. I need to know this is a done deal and will get finished and closed in a really quick, timely manner. That's what the benefit is. So you're a new investor trying to figure out, what do I do? What's my first step? First step is what can you afford to get into based on your income, your credit, and your assets, as we just talked about, how much money have you saved? Can I buy a property? And if so, how much can I afford to pay for that property? Right? That's what we exist to walk someone through and hold your hand and say, okay, let's figure this out. Can you afford a $100,000 property? Can you afford a $500,000 property? Let's figure out how the math and cash flow is going to work with regards to that payment that you're taking on, with regards to the money you're going to end up borrowing, so that you don't get yourself in trouble. That's the biggest challenge. Everyone wants to get into real estate, period. End of the sentence, right? But can you afford to do it? And how much risk are you putting on yourself and your family? I say this all the time. If you're going to be up at night stressing about finances and real estate, now I say every night, then you're in the wrong business. Everyone stresses about real estate. Everyone stresses about everything in life. You shouldn't sleep like a baby every single night, but you certainly shouldn't be awake every night stressing about the real estate investment you made. You want to find the right balance. I can afford this. It's a little bit of a stretch maybe here and there, but I'm not going to go broke. I'm not going to lose my house. I'm not going to lose every penny of my savings. And so that's where that balancing act comes in, being able to work with someone who is trusted and reputable and honest and authentic in running through that math and analysis with you is so important that you don't get taken advantage of. And that's where I think working with a local partner makes all the difference in the world, as opposed to some of the national players They're just looking to churn product and get rid of loans. That's all.
Yeah, agreed. I want to briefly hit on a point that you semi hit. I think it's valuable for investors. When you talk about not wanting all of your cash, so everybody knows, and I'm very transparent, we often purchase property with cash and then refi out, and we do it in a 3 or a 6 month period. But if you're using some sort of like a BRRRR strategy, it's hard money lending is especially going to pay off in the long run, or you could miss out on deals just because you have money stuck in your deal and it's going to take a seasoning period of 6 months to refinance out to a different instrument. And a seasoning period just means how long you have to own that property.
We constantly hear from people who are renovating a property on a street, and a neighbor will come up to them and say, hey, I've been thinking of selling my property as well. You're doing really good work here. I might be interested. And that investor will call us up and say, I messed up. I bought this with all cash. I funded the rehab with all cash. I literally have like $10,000 in my bank account. What do I do? So that's what we're here for, right? So next time, use us. But in the meantime, I can refinance you out, because we do that as hard money lenders too, from a cash buyer who says, listen, I'm in this property for 220. Can I get 50, 60, 70% out? We'll say, absolutely. And I can do that quickly. So you have an opportunity to pick up the neighbor's place across the street who wants to sell it to you and to you only. They don't want to work with a realtor. They don't want to put it on the market. They don't want people, prancing through their house. They just want to go to someone who they trust and they think you've done a really good job. And so we get those all the time where you just don't have access to additional cash, and it's tough to grow your business that way. And so that's where leverage and borrowing that money is key. At a point, David, you and your partners and your team has gotten to makes sense for sure. But for a lot of new people, they generally don't have that kind of access to funds on their own to do that cash purchase. So we say, look, generally speaking, 20% down of the purchase price and closing costs, you can buy a property. Now, if you think of the opportunity of leveraging, accessing funds, that's not a large investment to be able to have access to a heck of a lot of money. And that's really where the opportunity to use a hard money lender allows you to really grow and do more faster, quicker, and better. Having said that, I would discourage against taking on more than you can take on, right? I've had people call up and say, we're going to buy 3 properties out of the gates here. And I say, I really don't recommend that. Okay. You don't know how to do the rehabs. You don't have the contractor set up. You're taking on a heavy debt load. Let's walk before we run. And that's always an important lesson to learn in real estate investing.
Yeah, no, I agree. This is a question I like to ask everybody that's a specialist, as I think it's important for investors to be able to look ahead in the game of investing and see what business looks like after their first or second deal. And the question is, how do most successful investors that you work with use hard money in their strategy?
Our largest, I have a handful of people who have north of 200, mid 200 units at this point as holds, right? So they built up a large rental portfolio. Along the way, they flipped maybe about the same amount, okay, over a number of years. And we were with them early on as they were growing their business. And there is no doubt, and they would sit there and say all day long, the money and access to funds that we were able to give them was instrumental in their success. It just allowed them to access more money, buy bigger places, buy more places, and not miss out on opportunities. Even as they're growing their businesses, whether it's BRRRR, whether it's flip, whether it's a combination of both. And a lot of people make those decisions on the fly, right? Depending on the market, depending on opportunities. So I'm buying it really good. I think I can renovate pretty fair amount of money, pretty reasonable amount of money. Then you know what? Maybe I'll flip this place. I've had people planning on flip, and then all of a sudden someone says, I want to rent this, and the cash flow is going to be pretty good. And they say, I'm going to change my mind. I'm going to rent it. So you can go in any direction, but regardless of which direction you're going in, a lot of those investors, even as they're building up large portfolios and have a lot of cash, they're still saying, you know what? This is an efficient way for me to access funds. I have a partner looking out for me, which is us as the lender, keeping an eye on the rehab draws, keeping an eye on the finances, making sure, as I said, not too many eggs in one basket. And it's just been part of that growth strategy. Whether you're buying a $200,000 place, we have guys who are buying portfolios that are $2 or $3 million. It still allows them the best and easiest way to grab those properties quickly when things come on the market. Then work on that long-term strategy of the exit. We work with clients all day long on the 30-year debt service coverage ratio loans or other types of partners that we can connect our clients with to connect with a lender who's going to allow for a 5 or 10 or 30-year financing option, to get out of our loans. Our loans are 1-year loans. No one is meant to get into a hard money loan and work with a hard money lender as a long-term solution. We are a short-term solution. As I mentioned before, quick and easy access to funding, and then access to do rehab if you need. So we're all about making you acquire the property and do any work you need to do in a fairly quick time. And then once you're stabilized for rent and or rehabbed and ready for sale, you're going to pay us off either through a refinance or through the flip of selling that property. And then you're going to turn around and do it over again. And that's what those real estate investors are doing, constantly borrowing from us. Some of them are borrowing a lot from us over and over again because there's opportunities they don't want to miss out on.
So I totally get the scale and the vision that I want to paint for people so they can understand. Talk to me at a very simplistic level. Like, are they finding a property that needs work? They're finding it at a discount. They're rehabbing it. So they have a, let's say loan to value or ARV. They're looking for a 60 to 65 LTVs. If they think the property's worth $100,000 for very simplistic math, then they are going to try to get that property for 60 to 65,000. They're going to reach out to you. You're going to lend on that property. They're going to fix it up, whatever that might be, $20,000. And then they're going to refinance out at what LTV for a DSCR, 75 or 80?
Generally 75. The 80s have gotten a little more difficult in the current environment.
Gotcha.
I believe the 80 will be back and will be easier. There are some 80s available, but it's a little more challenging. So in being conservative and running the estimates for a client, I like to say 75 is the safer move.
Gotcha. And is there certain spreads that those clients are looking for? Just to be clear, those clients are doing value add. Am I correct? The most successful investors that you work with that use hard money lending are looking for properties that need work. They're not purchasing a new construction home. Am I wrong, right?
They're not purchasing a new construction home.
Gotcha.
There are always exceptions, right? Because again, that rush time frame comes in where they just have an opportunity and they need to close it in 5 days and they'll come to us for that. I did a new construction that was like that. It was a fascinating deal. But generally speaking, no, they are doing value add. They're trying to find opportunities where they can, again, increase that value, have that ARV, that after repair value, make sense at a good equity level to be able to make the exit work so that they can be cash flow positive on this property as a whole.
Gotcha. And those investors, they're your most successful investors that work with you guys, do they shoot for 80% LTV once it's rehab? So after they've got the loan, they've gotten the draws, they've done the rehab, are they looking to be, hey, I want to be at 80% of the value?
Correct. Ideally, no more than that at all, right? They'd love to be at 70, 75. The lower, the better, right? Depending on how much work to be done. And that's an analysis that we help our clients with too. And that's really, again, us going above and beyond, not leaving a client, especially a newer person, out there in the open to say, well, let's see if your LTV makes sense or not. We'll find out. We're really trying to do that homework on the front end. Now, no one has that magic ball to predict what's the market going to look like, what are the values on that street, that neighborhood, or that zip code going to be in, say, 6 or 9 months, or maybe a year, depending on how big the rehab is. But we do the best we can to try to predict based on most recent comps. And this is really where things can get dangerous in the current environment. We have a lot of people that call us up and say, well, in early 21, this property sold for X. And I say, well, early 21 was a long time ago, and quite frankly, a bit of a lifetime ago, based on how our world works right now. I don't really care about comps from 21, right? So I need to be realistic in working with you as a new investor to say, hey, I don't think that ARV makes sense. And one of the things we do ourselves is go above and beyond to give people the this doesn't make sense sort of conversation, the talk we have with them. It doesn't help us win more deals or make more money, but it's not all about the winning more deals and making more money. It's about a long-term relationship with someone. And so we'll say to clients on a somewhat regular basis, I think you're overpaying for this. I think you're underestimating the rehab, and I think you're overestimating that ARV. I don't think this deal works so well. In the interest of transparency and honesty, I want to let you know, I don't think you're going to be able to get out of this, or I think you might have to bring money to the table at the refinance to pay down the mortgage because the LTV may not work. Now, we have clients who say, I've got the cash, I'm okay with that. And I've seen their finances. And I say, if you're okay with it, I just want to make sure I'm being clear with you that your ARV is just out of whack. We've been right sometimes, we've been wrong sometimes. But it's important to have that honest dialogue, to not have people think every property always goes up X percent no matter what you do to it. That's just not reality. It has been for most of the last 10 years. Okay. But as I said, as we talked about, I've been in this business a long, long time. What goes up must come down. It doesn't always keep going up forever, and it doesn't always keep going up at the same rate forever. So you have to really factor in some worst case scenarios and be conservative on some of the estimates and some of the math formulas you're looking at to say, hold on, what if it doesn't work out as planned? One thing you can be sure of in real estate is that there will be many situations where what happened and what was planned did not end up being the reality at the end of the day. And you have to go in with that open mind to be like, as we all say, stuff happens, right? And be prepared for stuff to happen and say, wow, I wasn't planning on going through 2 contractors who disappeared from me. I wasn't planning on having arguments and issues with my partner. We see that all the time. I wasn't planning on life-changing events that impacted my finances, my job. So when those things happen, they impact that deal being as successful as you hoped. So let's factor in some worst case. Let's have a conversation and make sure we're safe and protected if things maybe go south a little bit as well. And how can we make sure to sort of help educate, inform, and protect you as best we can from those potential downsides?
Yeah, I think that goes over the point of just having another person in your corner. Like Trius Lending, having you guys in somebody's corner, just because sometimes, I mean, we need ego checks of, hey, we're doing everything right. Oh, I've done 20 properties, and sometimes you just need a check of somebody else. I mean, it never hurts to hear, hey, I'm not sure about this ARV. It makes you double check and go, you know what? I'm confident in it. But at least it makes you have that little person on your shoulder that says, hey, I think you might need to double check this. Iron sharpens iron. Hey, you're going to be a better investor when you have people that are doing it all the time on your team. And a lot of times you guys can bring different experiences like, hey, we just did a property on that street that just, they're thinking they're going to get X ARV. You're telling me you're thinking you're getting 50K. Somebody's wrong. I hope it's not you, but just in case, I want to give this information to you.
You're 100% right, David. You asked a minute ago, what do the seasoned people do? That's one thing our seasoned, experienced people who've been with us for years and years and years still do, is still lean on us for our expertise and our knowledge in this marketplace. We know this area. We know the streets. We know the neighborhoods. We know the greater Maryland area and the mid-Atlantic. We have a comfort level with it. That's tough to find, there's only so much research you can do online versus being able to talk to someone who has just funded 15 properties within that zip code in the last 3 months. I've seen whether the basements are finished or not. I've seen whether they had to bump out the back or not. I've seen what they did upstairs or downstairs or in the landscaping or what have you. That helps your rehab. That helps your ARV. It helps you understand what's going on. So those investors who have hundreds of properties and have the money very often to be able to afford to buy for cash, pay for cash, will still say, you know what? I still want to come to you. I want to borrow from you. I want the expertise. Can you meet me down there? I'm trying to push the envelope on this ARV. I don't know. I want another set of eyes on this one. I want to do a walkthrough with you. Yeah. Absolutely. That's what we're here for. I don't know if you can put a price on that. It can be incredibly valuable to our clients and to those seasoned people, and obviously, especially the new people as well.
I think that's great. I think that's one of the benefits of having a local team member. I mean, I feel like I'm constantly telling people that real estate is local and that so many people want to just blanket real estate. Hey, what's going on? What do you think is going to happen with, I mean, I hear this. I mean, I think I heard this yesterday. Somebody's like, what do you think is going to happen with prices? What do you think is going to happen with our home prices?
The $1 million question.
I don't know. Like, where's your house? I mean, did the only employer Hershey just leave your town? Well, then your price is plummeting. I was like, there's no like macro, unless there's some black swan event that just tails everybody down. It's so localized, and especially in Baltimore. I'm sure you know this better than I do, where you can have one property across the street that's selling for $800,000, and then you can have one literally across the street where everybody would say, I mean, these are comps. Yeah. Technically they're comps, but not really, because they're across that main street. I'm usually thinking of York Road whenever I'm like, hey, they're across York Road. I mean, you're at 125. Sorry, you're not getting 600. It's just not going to happen.
Yep, for sure.
That was one of the things that was like mind blowing a long time ago. I was like, man, this is crazy. I was like, these are all, and usually that means there's opportunity because there's some sort of disgruntled, or there's just opportunity when there's that big of a disparity. So are you guys local just to Maryland, or do you lend anywhere? I know you brought up that point of being a great team member in an investor's corner.
We lend throughout the mid-Atlantic. So our sort of core is Maryland, everywhere in the state of Maryland. We lend everywhere there. We have a tremendous amount of experience there. We also will do DC, Northern Virginia, We're dabbling in sort of the rest of the state of Virginia, Southern Virginia. We do some business down there, but it's sort of hit or miss here and there, case by case. We will do southeastern Pennsylvania. So York, Harrisburg, Philly, we'll do that as well.
Gotcha.
We've done some deals in Delaware on the beaches as well.
Eastern, northeastern. I mean, mid-Atlantic, I have a hard time even understanding what mid-Atlantic.
Right. I mean, I'll tell you, generally we do, a few hour drive from our office in Towson is really the bottom line because we visit all of our properties. We want to make sure we can access them.
Josh, can anyone qualify for hard money lending, or is there a certain credit score, or is there something that sticks out where you're like, hey, hard money lending is just not going to be for you?
Yeah, very common sense approach, right? We're not credit score driven. We're not specific debt to income ratio or specific income requirements or experience requirements. Very common sense. How has your credit history been overall? Do you pay your bills on time? Yes or no? Can you afford taking on this new payment, right? If I look at what you bring home on a monthly basis from whatever job or self-employed or what have you, we're open-minded to self-employed and looking at your income and different ways of calculating your income. Can you afford to take on this new payment, whether it's $1,000 or $7,000 a month? Can you afford it? And can you show me how you can afford that? If the answer is yes, you're good on your credit history. You for the most part paid your bills on time. I'm not concerned with the T-Mobile bill or a medical collection here and there. I'm concerned with your car, your credit cards, and any homes you might have had currently or in the past. So do you pay your bills on time? Can you afford to take on this new payment? And do you have enough money for the down payment and closing costs? If the answer is yes to all of that, we're good to go. Pretty simple, pretty easy. It's a process we do in-house in our office. Decisions can be made literally same day within 24 hours.
Love it. What are typical rates for hard money? And I want to caveat that as well as, can you explain points and what they are?
Typical rates, our rates are going to range from generally 12 to 13%. That's sort of the common rate out there in the hard money lending space. If you're a really seasoned, really top-notch investor, it gets a little better. If you're maybe not so great and have had some issues with income and assets and credit in the past, it might be a little higher, but that's generally the range. And then on the point side, and I'll take a second now, Dave, and explain points. A point is a percent of the loan amount, not a percent of the purchase price, a percent of the loan amount, the amount you're borrowing. So if you're borrowing $70,000 against that $95,000 purchase and $50,000 for rehab, whatever it might be, say it's a $120,000 loan, 1 point is 1% of that loan amount. So that would be $1,200 in that case. Generally, the points range from 2 to 4 points, with 3 being the average. Okay, and that's how we make our money, right? We make our money by charging that fee up front. So you pay those points at closing along with the closing costs. And that's sort of the general A to Z of how the process works. It's an interest-only loan for 12 months. So you're not paying down the principal. You're just paying the minimum payment due, which is just the interest that accrues each and every month.
It goes to showing newer investors that hard money is a tool. It's just another tool in your tool belt. Right. You use it when you need to use it, just to hit back. And so people totally understand, and give them a super simplistic example. Hard money lending, for instance, if you are getting $100,000 loan and you're paying 1 point, like Josh said, 1% of the loan, $1,000. 4 points, 4% of the loan, $4,000. So points, just like you said, you explained it really well. And then as far as hard money, is there a minimum that normally you can borrow from a hard money lender? I know that ends up becoming sometimes an issue for investors, or.
Yeah, so there's different lenders who handle different levels of sort of loans out there. I have a friend of mine who does, $2.5 million his floor for lending in the hard money space. So he's doing larger commercial transactions. Our floor is $100,000. I have some relationships in the industry locally who will go down to $15,000 and $20,000. So we generally don't do those smaller loans with that $100,000 floor, and that is a combination of both the amount we are lending to you for buying the property and the rehab combined. So we total both numbers together to get to that $100,000 minimum. The sweet spot for us at Trius Lending Partners is a $100,000 loan to about a $1.5 million loan. That's sort of our range where we do most of our business then. We've done some larger stuff. We've done some smaller stuff. We're generally not a huge fan of the ones that are outside of that range.
Gotcha. And I would just want to hit back to, for investors, if they're putting in a rehab budget, and let's say the ARV is $200,000. So that's what it should sell for when it's fixed up. Yep. Their loan and their rehab should be at what, if we're talking about LTV?
Generally, you want the amount of money you're borrowing, you don't want to exceed 60 to 65% of that ARV. So if you think the place is worth $500,000, you want to take that number and you don't want to borrow more than 65% of that number.
Yeah.
Generally, sort of the number that we like to see out there, the lower that number is, the better and safer the deal is. The higher that number is, the potentially riskier that deal is. I've had deals where people are doing deals where they didn't plan on it, but it ended up being more like an 80 or an 85 loan to value against the after repair value, just because the market changed or their expenses went up or they had to borrow more than they initially expected or what have you. But generally, you want to make sure you have enough equity that it makes sense both for an exit and or for profit on a flip.
Gotcha. And just for estimating purposes, I had to do some quick math there because I'm on the interview with Josh for $200,000.
Yep.
A 65 loan to value means you're looking to be all in for that property at 130, which is going to lead me in. So if you got, let's say you get the property for $100,000 and you have a 30K rehab budget, you're all in for 130, and then you can refinance out once you're done with your rehab. So if I reach out to you, I have a property that I want to acquire, already come up with a purchase price with the seller. How long does it take to close when we're using hard money?
Assuming the title company's ready, I've literally closed loans within 24 to 48 hours. Okay. The only delay is the title company. So if a client sends me the paperwork I need and I can have access to visit that property the same day or the next day, if it's that kind of a rush, I can get it done within a few days. So that is a possibility. We don't do that often, but we do it often enough. Generally speaking, our average is sort of 7 to 15 days, which is sort of the normal time for everyone to arrange their finances, the title company to do everything they have to do, the seller to be ready to make sure they're ready to sell. That's generally the average in the deals that we do.
Gotcha. But as quick as 24 hours, which is awesome.
It's all about turning around quickly and helping everyone get this to the finish line to move on to the next deal. Yeah.
I know Trius was recently featured as one of the fastest growing companies. Was it Fortune 5000?
So we were top 500 in the Inc. 500 last year. We were number 673, I believe, this year in the Inc. 5000, the national rankings. And last year we won the Baltimore Business Journal fastest growing company in the greater Baltimore region. So we're really honored to have grown really significantly. And that's not just in the real estate or finance area. It's all businesses. There were technology companies and consulting firms and all sorts of different companies out there. So we've had a really tremendous growth trajectory over the last few years. It's been really exciting. And it's just, it's our service, it's our attention to details, it's really looking out for our clients, for our investors, and just doing right by everyone. We have seen has translated into something quite successful. We're really happy and really proud.
So congrats again. The reason I actually hedged with that is, let's say an investor is not in the Mid-Atlantic region, and let's say they're cross country. I mean, you guys have some awards, you've had some accolades, you've been in business for a while. What should a newer investor look for, or how would they find like a hard money lender that they know is not going to be fly by night and just gonna be like, hey, wire me over 50 grand and then
I mean, a great question. So a few things I would say is, one, we don't charge upfront fees. That's always a bit of a flag when a hard money lender is asking for a $1,500 or $2,000 or a $2,500 down payment or an application fee or something like that. I'm not a huge fan of that. We don't do that. I don't think that's a great way to go about doing business personally. The other thing is really trying to work the word of mouth reputations. And as we all do in the world right now, checking social media, right? So our Google reviews are 235 star Google reviews, which for a small local company is a lot of views. And that's really been important to us. We've gone out of our way to make sure people share their experiences with us as they are great experiences. And so I think working with someone who has those kinds of reviews and you can read through and get a feel for the business you're working with is really, really important. It makes a big difference out there. And then word of mouth, right? Going to the investor groups, both on Facebook, in person, different investor meetups within the local community, and asking around. You'll quickly find out who the bad apples are, and I think you'll also quickly find out who the good, honest, transparent lenders and partners are.
Yeah, thank you for sharing that. Thank you for sharing that red flag, because I did not know about that one as far as upfront fees. Is there anything investors can do to get the best rates, to be the most lendable investors?
Super easy. So the best way to do that is, number one, be honest. I know that sounds pretty common sense and no brainer, but so many people are full of baloney, full of you-know-what. It's ridiculous out there. Okay. Don't tell me you make $1 million if you don't. Don't tell me you have $1 million in the bank if you don't. Just give it to me straight. Tell me exactly what's going on. That's the first and most important lesson, I think, in all of real estate investing, certainly in applying with a hard money lender and working with a hard money lender to borrow money. Okay. Just don't give us the stories and wrong story and lies. Be honest with us. Tell us what's going on. Let's see if we make this happen. We're here to try to help. Putting that part aside on a more technical sort of basis, good, clean, thorough information, right? I've been in the mortgage business a long, long time. We always say garbage in, garbage out. The best loans submitted with the most complete paperwork and information, thorough, detailed, organized, is the best. I've had real estate investors who own 60, 70 properties, and I've said, hey, can you send me a real estate own schedule? Like, yeah, I don't have one. I own a lot of places and I make a lot of money. That's not going to fly. Conversely, I've had people who own 50, 60 properties. I say, send me a real estate own schedule. They've got a spreadsheet to me in about 15 seconds that has every detail about every property, when they bought it, what they paid for it, what they owe on it, what the taxes are, what the insurance is, what the lease terms are, what their mortgage payments are. That's what it should be. That's what every real estate investor should have. When I ask them for their assets, yes, a personal financial statement helps, but show me the actual statements. Let me see what's going on. Let me see what's really happening. I don't need 6 years of tax returns and 6 years of statements and 6 months of statements. Just show me some income, show me the assets, show it cleanly, neatly, in an organized way that I can understand what's going on here. When people try to shove a lot of junk into the bucket, I guess, so to speak, it looks like junk and it raises flags to say something's not right here. Why can't this person just be straight and give me clean, big breakdown of their income, their assets, and their credit? That's all I'm asking for. When someone doesn't have that REO schedule and owns a lot of properties, that's not a good sign. That's not the kind of investor we really want to work with, because they can't tell up from down, left from right, and top to bottom. That's a big concern.
Gotcha. My takeaways there are integrity and transparency. And
100%.
probably in most
100%.
lenders, especially in hard money lenders, I would assume you're looking for the bad actors.
We're lending a lot of money to you as a client. I want to lend a lot of money to you, but I need to be protected too. We have people who fund these loans. We have investors that we raise money from who fund these loans, and we want them and ourselves with our money to be safe. And so we're looking out for you. We're looking out for us. We're looking out for everyone. I don't want to deal with defaults. I don't want to deal with takebacks. The question always is, what happens if everything goes wrong with this property and with this borrower? And I want to be able to know that I have a good reputable borrower and a good reputable property.
Goes both ways. You want to treat it like a friendship or like a relationship, and you're not going to want to be, holding back information. All that makes sense. Thank you for sharing. I have a few just more fire round questions. You don't need to give in-depth answers, but I'm curious. I'm sure the audience is. Before we get in it, guys, I really appreciate, Josh, I really appreciate you coming on, sharing your wisdom, sharing your experience in the mortgage industry. Before we go on, if you guys like this kind of content, please like and subscribe the video. Also, what's the best way for the audience? They're looking for a property. They want to reach out. They want to partner with Trius as a lending partner for hard money or for DSCR. I know we're not really going into DSCR in this. I've gone into it in other videos, but Trius also does DSCR. Am I correct?
We do, and always happy to help on the short-term financing, long-term financing, and always happy to help be a resource, right? I'm happy to help answer questions and just help walk someone through the process. I've had people, I've done some podcasts in the past. I've had people call me from Indiana, Michigan, Texas, California. Just happy to help. Happy to help spread the good word, spread the love, and it always comes back down the road, right? And it's always a good thing. So happy to help wherever we can. Best way to reach us is social media. We're all over the place. TriusLending.com. TRIUS lending.com. The key is a lot of people confuse us with Truist Bank. TRUI. We are not that. TRIU. Try us. And the term we use is try us, you'll like us. That's how you can remember how to say the name. Obviously, it's not spelled that way, but TRIUS lending. Happy to help answer any questions. Happy to reach out to anyone.
And we'll put all your contact information in the description for people.
Thank you.
So the fire round questions, one is, what do you think interest rates are going to do in 2024?
I think flat. I think at this point, we've sort of come close to or at the high that we're at. Don't think they're going to be coming down anytime in 2023. 2024, at some point, a little bit of a pullback, but I think it might take a while. So if you're talking June 2024, it still might be flat to where it is now, maybe comes down after that. So that's my thought.
I like it. It's conservative. I guess if you want to get really conservative, you just say they'll just keep going up until we break the economy.
Hopefully not. Hopefully not.
I like that answer. That's where I fall in as well. Number one area, and I'm just going to limit you to Baltimore. Number one area in Baltimore that you see from a value standpoint that you're like, I think properties here are undervalued. If I was going all in, I'd go all in right here.
So hard to predict. I can tell you that the Dundalk market has been on fire and continues to be on fire. And as a rental area, I continue to hear about incredible rental numbers that it is commanding down in the Dundalk area. Pockets throughout the city. Again, it's Baltimore, street by street, neighborhood by neighborhood. So I don't see any one area that's specifically undervalued. Here's what I would say. You got to be out there hustling street by street, block by block, and really networking to find those opportunities. They're in the city, they're in the county, but I'm hesitant to give any specific area. People love Baltimore County right now. There are some opportunities there. You got to dig deep and you got to really find the random streets and pockets and neighborhoods to do it. But we've seen some people doing some good business there.
What area of Baltimore County is attracting a lot of investment?
So around, and this goes for both city and county, around the universities, right? We've seen some deals recently around Towson, around Morgan State. We've seen stuff around Johns Hopkins. Those have always been pretty good areas. But I still think people have been heading even further outside of the sort of immediate areas there and finding opportunities there. And quite frankly, in the downtown area around Johns Hopkins Hospital, I still see people finding opportunities there as well, which is mind-blowing to me at this point. But there are still opportunities there as well. So trying to latch onto a college, a university, or a hospital always seems to be a good predictor and a good long-term play, because there's always going to be people working in those areas and attending those schools. So I think that's always a plus.
Awesome. I'm just going to give this a little bit of a plug. Trius accepts accredited investors into their fund.
Yeah, we have a mortgage investment fund that funds these loans. We pay investors between 8, 9, and 10%, depending on the amount of money they invest. It is a very secure and safe investment. In 20 years, no one has ever lost money investing with Trius Lending Partners, and that's a huge plus. Not many people can say that. And it's all secured by first lien mortgages on actual real estate. So you're not investing in a tech startup. You're not investing in a company that may or may not be around. You're investing in first lien mortgages that are on real hard property. And that's a very safe and secure investment at a good LTV, which is what we're always doing. And so as such, we believe it's a very safe and very conservative investment, and it pays a really nice, healthy return. And so it's a great opportunity for someone to have a hedge on their investment portfolio, maybe having some different areas. We consider this a relatively low risk and high return investment for our investors, and they've been very happy with the success over the years.
And very passive, right? I mean,
very passive, nothing to do other than sit back and get your payments every month.
Sometimes that is underlooked of like, oh man, I'm getting a 15% return, but I got to answer every single phone call and take those monster renovations that it's
nothing to do here. Nothing to do here. Yep.
Awesome. And people can invest with their self-directed IRA?
Correct. Very popular way to do it with your self-directed IRA. Obviously, beautiful tax situation then. Yeah.
The last question is favorite real estate business. It can be real estate or business book.
I recommend, I don't even know what it's called, Sam Zell's book about his history and experience in real estate. He recently passed. Very successful real estate investor in sort of larger commercial stuff, but he's been in everything over the years.
Am I being too subtle, right?
Am I being too subtle? He's a very direct guy, old school. Yeah. It's a phenomenal story of working hard, always hustling, and finding incredible success to the tune of billions and billions of dollars in his pocket over the years. It resonated really well with me. I just like his style of business, and it clearly worked incredibly well for him as well.
Really appreciate you coming on and educating newer investors about how they can use hard money to grow their business and how they can use Trius Lending to be in their corner to become a better investor. Yep. So I appreciate your time, spending so much time. And guys, if you want to reach out to Josh, again, we'll put his contact information in the description of the video. And we appreciate you listening and learning how to be, a better investor and invest in real estate for financial freedom. So we'll see you guys in another episode.
Thank you.